Well, hey, it's Dave DeBow, and welcome back. Today we're going to be talking about how much investment property can I afford? Why is this important? Because you want to go big, don't you? All right, so today's video is going to be talking about how much investment property can you afford, and that depends on a lot of things. It depends a lot on the size of the kind of property you're going to be buying and if you're going to be living in it or not. I'm also going to share with you a free hack on getting professional advice on exactly how much property you can afford. And then we'll take a look at how you can buy as much property as you want, irregardless of how much you could personally afford to purchase. Okay, so for simplicity's sake, we're going to be looking at small multifamily properties. Now, this applies just as well if you're buying single family homes, but just to keep it simple, we'll look at small apartment buildings or duplexes to get started. And we'll look at if you're going to be buying something less than 5 units, as well as properties that have more than 5 units. We're going to be taking a look at our little whiteboard here to make it clearer. All right, we're back, and the whiteboard fairy has miraculously filled this out for us. She doesn't have very nice handwriting, so we'll have to talk to her about that, but you get the idea. So the first thing we're going to talk about is if you're buying a property that's less than 5 units, 1 to 4 units. So let's say we're talking about a 2 to 4 unit type property, duplex, triplex, fourplex, that sort of thing. Well, the good news is that's going to come in under residential mortgage rules. Well, it could be good news, maybe not so good news, depends on your situation and if you're going to be living in it or not. But bottom line is, with residential mortgages, typically the banks are looking at you and your ability to pay. So that means your net worth, that means your income. That's what they're going to pay a lot of attention to when it comes to these kind of properties. So here's the good news. If you are going to be living in the property, then this is what we call a house hack. You're living in it, you've got tenants helping to cover the expenses, and you might even end up living for free in this revenue property. So that's house hacking. And the big benefits for this are, number one, because you're going to be buying this as your personal residence, banks tend to give you the best and lowest interest rates for these kind of mortgages. Why? Because the default rate for owner-occupied properties is significantly lower than the default rate for investment properties. So the bank knows that, hey, if you're living in this property, if it's your home, you're going to do whatever you need to do to pay the mortgage, all right, versus just a general investment property. So the lower interest rate, and that means they'll let you get in with a much lower down payment than if you're buying this property as just a purely rental property. So typically, if you're going to be living in it, you can get in for as little as 5 to 10% down versus the typical 20 to 25% down for revenue properties. And the not so great side of this, if you're doing a house hack, is the amortization rate, the length of the mortgage is typically going to be shorter than for other kinds of properties. So typically you're looking at a 25-year amortization rate. So that means your payments might be a little bit higher, but with the lower interest rate, it kind of balances out. So those are the big benefits if you are owner occupying the property. Now, what happens if you just buy this as a rental property? Well, different things. So if it's not going to be, it's no longer going to be a house hack. So we cross that out. It's going to be a rental property purchase, right? So unfortunately, you don't get the lower interest rate. You're going to pay a higher price. You're not going to get the low down payment. It's probably going to be closer to 20%. But good news is you get to amortize it probably for 35 years. So pros and cons to doing that if you're buying 1 to 4 units. So again, when you're doing 1 to 4 units, a lot of the bank qualifying depends on your personal financial situation and your income. Now let's take a look at what happens and how much property you can afford if you're buying 5 units up, and that is commercial properties. Snap, we're back. The whiteboard fairies filled this out again. Her handwriting hasn't got any better, but hopefully you get the idea. We'll walk you through it. So basically, if you're doing 5 units and above, this becomes a commercial mortgage. And to a large degree, the actual property is what helps qualify for the financing for this kind of a deal. So what the banks are looking at is how much revenue, how much money, how much profit does this property generate, and can it pay its own bills? So it's looking at that before it's looking at your personal income. Typically, the big banks want to look at and make sure that your net worth is at least 25% of the value of the loan. That means if something happens, they get into hot water, they can go after you and get the money they need to cover the mortgage payment. So they aren't going to look at your income so much, but they might look at your net worth. But what they really are going to be looking at is the debt service coverage ratio. And we'll talk about that in a second. But again, here's the pros and the cons of these kind of commercial mortgages. Cons are they're going to charge you more interest. Now, why is that? Why do banks charge more interest for commercial properties than for personal residences? Well, especially if the commercial property is generating revenue. Well, it doesn't make a lot of sense to me either. But bottom line is, again, it's all about risk. And big banks are very risk adverse. They don't like risk. What they've seen is that over the years, people will do whatever it takes to keep their house. However, if it's an investment property and things go south, people are more willing to walk away from that, even though they've had to put a lot more money down for it. So whatever the reason is, they feel that they're at higher risk, so they charge you a premium for that. They charge you more interest for that. They also require a lot more money as a down payment versus an owner-occupied property. So typically, if you're doing a commercial deal, you're going to be looking at least 20% as a down payment, perhaps as much as 25 or 30% down, depending on the property, or even higher in certain cases. But 20% down is quite typical. However, the good news is they amortize the property longer. So you're looking at 35 to 45 years for the loan amortization. So what does that mean? That means they give you more time to pay off the mortgage. So that means that you can lower the amount that you're paying every month. You're going to have to pay for a lot more months, but your actual monthly payment is lower by doing it that way. So pros and cons to that. Now, let's take a look at one of the ways that the bank is seeing if you qualify for this, or if your property qualifies for financing, is by looking at the debt service coverage ratio, which needs to be at least 1.10. Okay, so what does that mean? Well, let's just simplify this a lot. What the bank wants to see is that the property can easily cover the mortgage payments. So they want to make sure that your net profit, your net operating income, exceeds the mortgage payment by at least 10%. So for example, if your mortgage payment is $1,000 a month, just for simple math, then your net operating income needs to be $1,100 a month at least. So what is net operating income? Well, it's your profit at the end of the month after you've received all of your rents from your tenants, all of your income from laundry or what have you, or parking, wherever it comes in from. You've got all that income, and then you take off your expenses except for the mortgage payment. So you take off your property taxes, you take off your insurance, you take off your contingency funds, you take off your bills, all of that stuff that comes in, your non-mortgage expenses, that is your net operating income. So if that is at least $1,100 a month and your mortgage payment is $1,000 a month, there's $100 cushion there, so the bank feels comfortable to loan on this property. The higher, the better for the bank as far as they're concerned. Now, here's a big tip for you to figure out exactly how much you qualify for, how much investment property you can afford personally, and that is to get a really good investor-focused mortgage broker. Not just a regular mortgage broker, but a mortgage broker that knows how to work with real estate investors like you and like myself. Because the reason is these rules change all the time, and different banks have different rules and different criteria. So a good investor-focused mortgage broker is going to be on top of all of the current rules and regulations for what kind of deals you want to do. So tap into those. That's a free resource for you. Okay, so bottom line, either way that you go here, this is really revolving around how much money you can bring to the table to buy more property. How much do you personally qualify for to buy more property? Well, what if there's a way to buy as much property as you want and not have to worry about how much you personally qualify for? Well, here's the good news. There is. And that's by working with joint venture partners and investors. So typically, if you're looking at these smaller type deals, you could bring on one joint venture partner to put up the cash and the credit to buy the property. You bring the deal, you bring the knowledge, you bring the team, you bring the management, and you buy the property together. They put in all the money, but you manage the deal, and then you share the profits. So what are the advantages to this? You can scale as big and as fast as you want to, as long as you can bring on joint venture partners and as long as you can find deals. When you're working with bigger deals, typically you're going to have to bring on a number of investor partners to do this kind of deal, so you might have to look at doing a syndication. That's a different kettle of fish. We won't get into that right now, but basically it's pooling people's money together to buy the property. So either way, you're able to scale. Now, what are the pros to this? You're able to scale bigger, faster, a lot easier than trying to do it all on your own. But some of the pitfalls are you have to be reporting to other people because you've got investors and you've got partners on board. They're going to want to make sure that you're taking care of business and taking care of their money. That's not a big deal because that makes you a better real estate investor. All right, so hopefully you found this little lesson helpful. If you're interested in finding investors and joint venture partners in order to scale your business, I've got a resource for you. It's my book. It's called Money Partner Formula. You can find it by clicking on the link in the description below or going to investorattractionbook.com.